Most people look at gold and see something eternal, a metal that has survived empires, wars, inflation storms, currency collapses, and every cycle of human greed and fear. But every era eventually faces the same dangerous assumption, that something which has always held value will continue holding it, no matter how the world changes. And that single assumption is what quietly, almost invisibly, has begun to crack beneath the surface. Because for the first time in decades, the forces that once guaranteed gold's safety are now shifting, colliding, and reshaping themselves in unpredictable ways. And if those forces continue converging, the world could be walking straight toward a scenario investors refuse to even imagine. A historic gold correction, maybe even a crash, sometime around 2026. The question is not whether gold will ever fall. The question is why so many people have convinced themselves that it can't. And whenever investors fall in love with an idea, Buffett always reminds them that love does not protect you, it blinds you. It makes the story feel safer than the reality underneath. So if you want to understand why smart investors are growing uneasy about gold's trajectory and why Buffett himself urges caution whenever an asset becomes a universal, safe haven, you have to step back and examine the deeper mechanics, the psychology, the history, the risks that never make headlines until it's too late. Because the signs don't start with gold prices, they start with confidence, and confidence is the very thing that cracks quietly at first. For decades, gold lived in the shadows of more exciting assets. Stocks soared, real estate boomed, tech transformed the world. Gold wasn't a star, it was insurance, something you kept in a drawer, not something you bragged about at dinner. But when inflation returned, when governments began printing money at historic levels, and when geopolitical shocks rattled almost every major economy, gold suddenly found itself at the center of attention again. It climbed again, then broke all-time highs. And with every new record, more people began treating gold not as insurance, but as destiny. That shift may sound subtle, but it's dangerous. Because the moment an asset becomes emotionally comforting, investors stop questioning the risks behind it. They stop asking what conditions actually support its price. They forget that markets don't move because of myths, they move because of money flows, liquidity shifts, economic cycles, and human behavior. And that behavior is exactly what has pushed gold into a precarious position. Too many people are treating it as guaranteed safety at the exact moment when the pillars holding it up have started to wobble. Buffett often said, gold just sits there. It doesn't earn, it doesn't grow, it doesn't innovate. It shines, yes, but it doesn't produce. So at the end of the day, gold's price is completely dependent on sentiment, and sentiment is fickle. It can turn in a heartbeat, especially when the financial world is undergoing tectonic shifts that most investors haven't fully processed. Interest rates at levels that make fixed income more attractive. A strengthening dollar that quietly puts pressure on global commodities. Governments selling reserves to manage cash flow. And perhaps most importantly, the rise of new store value narratives, from artificial intelligence to digital assets, that are beginning to compete with gold's thousand-year brand. That's the part no one wants to talk about, because admitting that gold could lose its psychological monopoly as the ultimate safe haven feels like heresy. But every generation believes the things their grandparents trusted will always remain unshakable, until suddenly they don't. History is full of assets that seemed unbreakable until the world changed around them. Dutch tulips, Japanese real estate, .com stocks, even US housing before 2008. And in every case, the crash wasn't caused by a flaw in the asset itself. It was caused by a flaw in the assumptions people built on top of it. Gold's risk today is not that it's worthless. Its risk is that it has become overcrowded, overtrusted, and overloved at a moment when global liquidity is tightening and investors are seeking places to raise cash. When too many people line up on the same side of the boat, the danger isn't the water, it's the weight. And then there's the paradox Buffett always highlights. What the wise do in the beginning, the fool does in the end. The wisest investors bought gold early in the cycle when fear was quiet. But now at new highs, the late-stage buyers don't even understand why they're buying. They're buying because others bought. They're buying because it feels safe. They're buying because gold appears to have no ceiling. And that belief that nothing can go wrong has preceded every major correction in market history. So could gold crash in 2026? The answer lies not in prediction, but in pattern. Markets turn when expectations detach from reality, when liquidity tightens faster than people are prepared for, when governments face debt pressures that force them to liquidate reserves, when alternatives emerge that pull attention, capital, and confidence away from traditional havens. And in that environment, gold is vulnerable not because it is weak, but because it is crowded. And crowded trades unwind violently. But Buffett's warning isn't to scare you, it's to steady you. He never invests based on fear. He invests based on understanding. And understanding means recognizing that no asset, not gold, not stocks, not real estate, not crypto, is ever immune to cycles. Value comes from discipline, from patience, from owning things that produce, create, or compound, and from never assuming that the past guarantees the future. Gold will always have a place. It will always be a hedge against chaos. But chaos itself can shift shape, and the world of 2026 may not be the world gold investors imagine today. So before you treat gold as a shield, ask yourself the question Buffett would ask: are you protecting yourself or comforting yourself? Because the difference between the two is what decides whether you survive a crash or get caught in one. In the end, gold won't crash because it failed. It will crash if too many people believed it never could. And the moment you learn that lesson, you stop chasing safety and start seeking wisdom, the kind that outlasts every bubble, every boom, every crisis, and every glittering illusion. And if you really want to understand why the calm surface of the gold market hides a growing tremor underneath, you have to look at the psychology unfolding behind the price charts. Because gold's strength has never come from utility, productivity, or innovation. It has always come from belief. And belief is the most fragile foundation any asset can rest on. Especially when millions of people begin leaning on it at the same time. Gold is not rising today because investors suddenly rediscovered ancient wisdom. It's rising because they're scared. Scared of inflation, scared of recession, scared of governments stretched thin, scared of currencies wobbling under the weight of debt. Fear pushes people into gold, but fear also makes them irrational. It makes them buy too fast, too high, too blindly, until the very safety they seek becomes the risk they never saw coming. That is why Buffett has always viewed gold with a kind of detached respect. He understands why it matters. He understands why people run to it. But he also understands the trap hidden inside. Gold can make people feel safe without actually protecting them, and nothing is more dangerous than safety that only exists in the mind. When an asset's price is driven more by emotion than analysis, more by comfort than logic, the foundation becomes clay, and clay cracks under pressure. But the unsettling part is not the fear that pushes people into gold. It's the shifts happening quietly in the global economy that could pull them back out. Because for the first time in years, the macro environment that supported gold's rise is starting to reverse. Central banks that once bought gold aggressively may need to sell to manage liquidity. Governments facing debt cliffs could tap their reserves. Investors who treated gold as a safe deposit box may rotate into higher-yielding assets as interest rates stabilize or decline. And if rates fall faster than expected, the appetite for risk assets could surge again, drawing money away from gold and back into equities and emerging markets. Capital doesn't stay loyal, it flows wherever opportunity feels strongest. And flowing out is just as powerful as flowing in. Look at history. Gold's worst declines didn't begin when the world was calm. They began exactly when people felt most certain that chaos would last forever. In the late 1970s, inflation terrified the world. Gold soared. Then inflation peaked. The economy entered recovery, and gold collapsed for decades. Investors who bought at the top didn't just lose money, they lost time. They sat in an asset that produced nothing, paying the silent tax of opportunity cost, while others compounded wealth elsewhere. Buffett called that the quietest but most painful cost of all, the cost you don't feel day to day, but that erodes your future. And it is that same cost that threatens gold holders today. Because while gold soaks up attention, innovation marches on. Entire industries are being reshaped by artificial intelligence, robotics, automation, digital finance, energy breakthroughs. New technologies are emerging that could shift the way people store value, transact globally, and hedge against risk. Gold has always relied on the assumption that it is irreplaceable. But history shows that no asset is irreplaceable, only temporarily unmatched. The more alternatives the world builds, the weaker gold's monopoly becomes. Buffett never chased gold because it didn't give him the one thing he valued most, compounding. He understood that wealth isn't built by holding something that stands still. Wealth is built by owning something that grows, even slowly, even imperfectly, because growth stacked over time becomes exponential. Gold cannot do that. It can surge, it can stagnate, it can protect during storms, but it cannot multiply itself. And that absence matters most when the world begins speeding up, not slowing down. Yet precisely because the world is uncertain, gold's rise has continued. Even those who don't fully believe in gold still feel pressured to buy it, worried they will be the only ones left exposed when the storm hits. But markets punish hesitation just as brutally as they punish overconfidence. And many investors buying gold today aren't expressing conviction, they're expressing fear. Fear that inflation will return. Fear that economies will weaken. Fear that currencies will erode. Fear that geopolitics will escalate. But when everyone rushes toward the same shelter at the same time, the shelter can collapse under the weight. That's why the timeline around 2026 has begun attracting the quiet attention of analysts, not because of a single event, but because of a convergence of cycles, debt rollovers peaking, government refinancing pressures intensifying, demographic shifts impacting consumption, geopolitical realignments reshaping trade, liquidity conditions tightening globally. Gold can thrive in chaos, but it struggles when the chaos begins to shift form. Investors who prepared for inflation may find themselves navigating deflation. Those preparing for dollar weakness may face dollar strength. And those preparing for geopolitical shocks may face periods of calm that leave gold drifting, directionless, and vulnerable to sudden repositioning. And beneath all of that lies the one truth Buffett never stops repeating: markets move in waves, not straight lines. For every surge, there is a settling. For every mania, a correction. For every climb, a moment when gravity quietly reminds investors that nothing escapes cycles, not even gold. And as you move deeper into the psychology behind gold's momentum, something becomes undeniably clear. The price today is not being driven by fundamentals, but by emotion layered on top of emotion. Investors are no longer asking, "What is gold worth?" They're asking, "What if I don't own it when everyone else does?" That subtle shift marks the point when safety transforms into speculation, even though no one involved wants to admit it. Because calling gold a speculative trade sounds absurd to most people. But any asset becomes speculative when its appeal stops coming from logic and starts coming from fear of missing out. Buffett has always warned about this quiet turning point, the moment when crowds start chasing reassurance rather than results. And crowds behave the same way in every era. When the environment feels unstable, they seek an anchor. When the anchor starts rising in price, they begin convincing themselves that the rising price is proof of its strength. They never stop to consider that it's their collective weight that's lifting it. And when millions of people are pushing the same asset higher for the same emotional reasons, they unintentionally create the very vulnerability they believe they're avoiding. But what most investors don't see or don't want to acknowledge is how gold's price depends on the interplay of forces that can flip almost overnight. Today's buyers assume global tensions will remain high, that inflation will remain elevated, that currencies will weaken, that governments will behave recklessly. They assume the world will continue being fragile, uncertain, chaotic. But markets are forward-looking, not backward-leaning. They don't care what has happened, only what will happen next. And when the future begins shifting in unexpected ways, even slightly, the assets that rely purely on sentiment become the first to wobble. Imagine a world where inflation falls faster than predicted, where supply chains stabilize, where interest rates decline, where corporate profits strengthen, where risk appetite returns. It doesn't require miracles, just a series of modest improvements. In that environment, investors will begin rotating out of defensive positions and back into growth opportunities. They'll move from havens to horizons. And when that rotation begins, gold's support can evaporate far faster than anyone anticipates. Not because gold failed, but because the narrative holding it up dissolved. The gold market is like a tightrope, steady as long as everyone walks carefully, but quick to snap when too many people attempt to run across at once. Look back at the early 1980s. Gold had soared to record highs as investors braced for endless inflation. They bought gold for the same reason people buy it today, fear. But when the Federal Reserve broke inflation's back with painful but decisive action, confidence returned. Slowly at first, then suddenly, gold didn't just slip, it plunged. And it stayed down for years, even decades. People forget how long it took for gold to meaningfully recover from those highs. An entire generation learned the hard lesson that an asset which produces nothing can stagnate for a painfully long time once sentiment breaks. And the echoes of that era are growing louder, because the forces propping up gold today are not permanent. They're cyclical, they're emotional, they're situational. Inflation may not behave as expected. Debt concerns may shift in form rather than intensify in a straight line. Geopolitical tensions may ease or transform. Technological progress may reduce economic fragility in unexpected ways. And if those changes occur anywhere near 2026, even modestly, they could catch an overconfident gold market off guard. But perhaps the most underestimated threat to gold's long-term stability is the rise of competing narratives. Gold used to be the default store of value. It enjoyed a psychological monopoly, but monopolies eventually face challenges. Cryptocurrencies claimed part of that narrative. Technology-driven assets are now claiming another slice. Artificial intelligence promises productivity leaps that could fundamentally rewire economic cycles. Investors today have more ways to protect their wealth, hedge their risks, and express their fears than ever before. And every new option chips away, even slightly, at gold's singular status as the world's comfort blanket. Buffett's skepticism toward gold wasn't born from disrespect, it was born from realism. He knew that gold's value doesn't come from usefulness, it comes from agreement, from trust, from a shared belief passed down through generations. But shared beliefs can weaken, especially in a world moving as quickly as ours. If investors begin trusting new tools, new technologies, new hedges even a little more, they may begin trusting gold a little less. And gold doesn't need enemies to fall, it only needs alternatives. Yet the most important risk of all is the one least discussed, the liquidity trap. In an environment where governments face rising refinancing costs, where consumers struggle under debt loads, where central banks maneuver cautiously, liquidity becomes precious. When liquidity tightens, people sell what they can sell, not what they want to sell. Gold is liquid, very liquid, and liquidity becomes a double-edged sword during stress. When institutions need cash, when governments need reserves, when funds need to rebalance, gold becomes the first asset out the door. It has no earnings to justify holding through pressure. Its value is psychological, so it becomes expendable. That is why 2026 looms as a potential turning point, not because of a catastrophic event, but because of the alignment of pressures that could force hands. Debt maturities, geopolitical recalibrations, interest rate adjustments, fiscal constraints, and global liquidity shifts all converge in narrow windows. And when too many forces converge, markets adjust. They always adjust. The only question is which asset adjusts first. And gold, for all its history, is not immune. And as we move even deeper into the forces quietly shaping gold's trajectory, the picture becomes more complex, more fragile, and more dependent on timing than most investors realize. Markets don't break simply because valuations stretch. They break when stretched valuations collide with shifting conditions. And gold today sits in a tight intersection of narratives, pressures, and expectations that may not survive the next realignment of global forces. People buy gold believing they're stepping outside the system, but the truth is that gold is more entangled with the system than they know. Gold responds to interest rates, currency strength, liquidity cycles, political stability, risk appetite, and global trade patterns. It responds to everything, and that makes it far more vulnerable to crosswinds than its myth implies. That's the irony embedded in gold's reputation. The metal is celebrated for being stable, timeless, immune. But the price of gold is none of those things. It's a mirror reflecting the world's anxieties in real time. When the world fears inflation, gold rises. When it fears recession, gold rises. When it fears war, gold rises, but fear is not a stable foundation. Fear moves like a tide. It recedes, sharp and sudden, often long before investors expect it. And when that tide moves out, it reveals how much of gold's current strength was built not on fundamentals, but on emotional overflow. Buffett would say that markets are voting machines in the short term and weighing machines in the long term. And in the short term, gold has received a landslide of emotional votes. But when the weighing begins, when the market shifts from reacting to evaluating, gold's true risks begin to show, not because the metal changed, but because the world around it did. Every surge in gold's price plants the seeds for its next correction, because every surge brings in new buyers who weren't hedging, they were hopping. And hope is the most fragile asset of all. What makes the next few years particularly precarious is the global transition underway. Economies are rebalancing from the shockwaves of the early 2020s. Inflation is cooling unevenly. Currencies are realigning. Debt pressures are building quietly in the background. And geopolitical power centers are shifting in ways that make predictions nearly impossible. Chaos doesn't need to continue for gold to fall. All it takes is a shift in the type of chaos the world faces. Gold thrives on the fear of inflation, but can weaken under the fear of deflation. It rises when economies overheat, but struggles when they stagnate. It surges when the dollar weakens, but falters when the dollar strengthens, even modestly. And then there is the dollar itself, perhaps gold's most important shadow opponent. Most people don't realize how deeply gold's price is intertwined with the performance of the US dollar. When the world seeks dollars, gold tends to soften. And the world is entering a period where dollar demand may surge unexpectedly. Debt repayments, global refinancing cycles, and shifting interest rate dynamics could tighten the supply of dollars, sending capital flowing back into US assets. Even a mild dollar rally could put outsized pressure on gold, especially at elevated prices. But the dollar is only one piece of the puzzle. The more serious threat comes from the liquidity cycle now forming. Liquidity is the oxygen of markets. When there's plenty, all assets rise together. When it dries up, investors scramble. And gold is one of the first assets people liquidate when they need cash fast. Funds don't sell their worst positions during stress. They sell their most liquid ones. Governments don't offload risky equities. They offload gold reserves. Households don't sell illiquid real estate. They sell the investments they can convert to cash instantly. Liquidity squeezes don't attack weak assets, they attack accessible ones, and gold is the most accessible of all. That is why a convergence of pressures in 2026 feels more threatening than any single headline event. Markets rarely crash from a big shock. They crash from an accumulation of smaller pressures that suddenly intersect. A period of tightening global liquidity, a stronger dollar, a shift in interest rate expectations, a rotation back into growth assets, a temporary easing of geopolitical tensions, a decline in inflation anxiety. None of these individually would break gold's momentum. But together, aligned in the wrong sequence at the wrong moment, they could trigger an unwinding of gold positions far more rapidly than investors expect. And the reason this risk feels invisible is that investors have fallen into the oldest illusion in finance, the belief that an asset with thousands of years of history is immune to the present. But no asset, no matter how ancient, is immune to positioning. When too many people crowd into one doorway, the danger isn't the room, it's the exit. Gold's risk is not that it is weak. It is that the crowd around it has grown too large, too confident, too synchronized. Buffett warns that what everyone knows in markets is rarely worth knowing. When an asset becomes universally loved, universally trusted, universally accepted as logical, sensible, and safe, it becomes vulnerable not because the love is wrong, but because it is unanimous. Consensus doesn't protect you. Consensus exposes you. It creates situations where any shift in narrative, no matter how small, creates a chain reaction. One institution trimming positions forces another to rebalance. One government selling reserves triggers sell-offs elsewhere. One change in rate expectations accelerates a wave of reallocations. And before anyone truly understands what's happening, the thing believed to be the safest asset becomes the center of instability. And beneath all of these surface risks lies the deeper truth Buffett always returns to: every asset must be judged by what it produces, not by what it promises. Gold promises safety, but it produces nothing. It cannot compound. It cannot innovate. It cannot adapt. It cannot create value. It can only reflect value projected onto it by others, and reflections distort fastest when the room grows crowded. And this is where the story shifts from warning to wisdom, because every market cycle, every period of fear and excitement, every surge and collapse ultimately leads back to a single question. What kind of investor do you want to be? One who reacts to headlines, who rushes toward the same door as the crowd, who mistakes movement for meaning, or one who steps back, looks past the urgency of the moment, and asks what will matter not in a month or a year, but in a decade. Buffett has made a lifetime out of ignoring noise, and gold's current momentum is drenched in noise. Not reckless noise, not foolish noise, but emotional noise, fear that masquerades as caution and confidence that masquerades as safety. Gold may continue rising for a while. Markets often reward the crowd temporarily, just long enough to convince them they were right. But temporary rewards do not make long-term strategies. Buffett always reminds investors that price is what you pay, value is what you get, and gold's price today reflects more hope than value. Hope that chaos persists, hope that uncertainty remains, hope that tomorrow resembles the fears of today. But building an investment strategy on fear is like building a house on shifting sand. It holds until the day it doesn't, and when it moves all at once. The strongest investors, the ones who build lasting wealth, don't chase the world's anxieties. They study them, they understand them, but they do not let them dictate their decisions. They look for assets that produce cash flows, that innovate, that expand, that compound, that solve problems, that grow with the world instead of reacting against it. They know that fear creates opportunities, but those opportunities rarely lie in assets that merely store emotion. They lie in assets that create value. That principle has guided every major decision Buffett has ever made, from the companies he acquired to the industries he avoided. And it is the principle that sits quietly at the center of his warning. Because gold's greatest weakness is not its lack of productivity, it is the illusion that it frees investors from thinking. People buy gold not because they understand it, but because they believe it will protect them without effort. But nothing in investing protects anyone without effort. Safety comes from knowledge, discipline, patience, and clarity, not from metal in a vault or digital numbers on a chart. The truth that Buffett repeats again and again is simple. No asset saves you unless you understand what you are trying to be saved from. If your fear is inflation, there are companies that thrive in inflationary environments. If your fear is recession, there are industries built to withstand economic downturns. If your fear is currency weakness, there are hedges, strategies, and global exposures that protect against it. If your fear is geopolitical conflict, there are sectors positioned for resilience. Gold is not the only answer. And in a world as dynamic and unpredictable as ours, relying on a single answer can be more dangerous than any of the threats you're trying to avoid. And so the conversation about 2026 isn't a prophecy, it isn't doom, it isn't a certainty that gold will crash. It is a reminder that cycles evolve, that narratives shift, that markets adjust. It is a reminder that investors who believe they are safe simply because they bought what everyone else bought are often the least safe of all. Buffett's warning is not that gold is doomed, it is that investors who stop questioning their assumptions are doomed. The moment you believe an asset is untouchable is the moment you stop seeing the risks forming behind you. In the end, gold's greatest purpose may not be to protect wealth, but to reveal something deeper about human nature. It shows how quickly fear can spread, how easily crowds can unite around an idea, how belief can inflate an asset beyond logic, and how fragile that belief becomes under pressure. It reminds us that markets are not machines. They are reflections of human emotion, amplified by technology, multiplied by leverage, and accelerated by the speed of information. Buffett has spent his entire life studying these patterns, watching them repeat in new forms. The commodities boom of the 1970s, the tech bubble of the 1990s, the housing mania of the 2000s, the cryptocurrency explosion of the 2010s. Each one felt unique, each one felt justified, each one felt safe until it suddenly wasn't, and each one ended the same way, with investors realizing that timeless wisdom outlasts temporary excitement. What he would tell you now is simple. Don't confuse movement with meaning, don't mistake fear for strategy, and don't rely on assets that cannot work for you while you sleep. Own things that create value, businesses, ideas, innovations, productive assets that move the world forward. Use history as a guide, not as a weight. And remember that the goal of investing is not to avoid every storm, but to own vessels strong enough to weather any storm. So as the world watches gold's climb with fascination, as forecasts grow louder and predictions more dramatic, the wisest investors will step back and breathe. They will ask the calm, simple questions that cut through panic. What is driving this? How sustainable is it? What happens when the narrative shifts? Where will my money compound? What will I be glad I own 10 years from now? And with those questions, the anxiety dissolves, the noise quiets, the world's fears shrink back to scale, because the only real safety in investing comes not from the asset you choose, but from the clarity with which you choose it. Gold may rise, gold may fall, the crowd may run toward it or away from it, but your future doesn't depend on their movement. It depends on your discipline. And that is why Buffett's warning is not about predicting 2026. It is about preparing for whatever 2026 brings. It is about understanding that markets are always changing, that risks are always shifting, that certainty is always an illusion. But wisdom, real wisdom, never goes out of style. It stays with you in the highs, in the lows, in the manias, in the corrections, and in every quiet moment in between. And if you carry that wisdom forward, gold's rise won't tempt you and gold's correction won't shake you. You will watch the cycles come and go with the calm of someone who knows that wealth is built not in the rush, but in the patience, not in the crowd, but in the clarity, not in the metal, but in the mind.